With us now to talk a little bit more about his shifting goalposts is Dick Berner. He is chief U.S. economist. He is also co-head of global economics at Morgan Stanley. Dick, thanks so much for joining us.
My pleasure.
You've changed 3 points in your research, talking about the sovereign debt crisis, saying it's created a more risky environment. How does that change what the Fed does here?
Well, it keeps the Fed on hold for longer. The debt crisis is a disinflationary event, and so we've seen inflation expectations in the marketplace come down, and I would expect to see that echoed in surveys of inflation expectations as well.
So talk to us, Dick, if you don't mind, about times and dates. I mean, according to your research, it seems as if you thought the Fed could move as early as the third quarter this year, but now you say they have to wait at least till next year.
Right. If we hadn't had the spillover from the sovereign crisis, then we felt the Fed was on track to begin taking away some of its ultra-accommodative policies in September. We now think that that will be postponed until the first quarter of next year.
You're also saying that there's going to be a change to interest rates in real terms. Give us the before the sovereign debt crisis and the after view.
Sure. You know, we still think the dynamics of higher real interest rates are in place for the U.S., but not to the levels that we saw previously. The analytics are that we have massive Treasury borrowing needs, and we think that the economy is strengthening so that private credit demands will come back. And the combination of those two things, along with some uncertainty about inflation and so on, would lift real interest rates. And we saw nominal rates, as a result, going to as high as 5.5% by the end of this year. Now we no longer think that. Our current target is 4.5%, reflecting the fact that we've seen a flight to quality into U.S. Treasuries, which is understandable. You referred to that earlier. And also the fact that we may well see investors change asset allocation as a result of that. And avoid risky assets.
So basically going from 5.5% to 4.5% as far as real terms or interest rates in real terms. You also say you boosted the forecast for U.S. growth. Is it just that the U.S. is less bad than everybody else right now?
Well, we boosted our forecast. We've been, you know, mindful of the fact that in the U.S. we faced cyclical tailwinds as the momentum from the recovery is strengthening. But also a lot of secular headwinds. And we see the cyclical factors starting to gain some strength. In particular, we've emphasized the notion that in the early stages of this recovery, and we still see this, that global growth outside of Europe, particularly in Asia and in Latin America, would be a source of support for U.S. growth. That's still the case. But now what's happening is we're making, if you will, a handoff from that source of strength to domestic sources as jobs pick up, as income strengthens, and that supports consumer spending. And as we see some of the cyclical forces at work domestically in the U.S. So that's the reason that we raised our forecast for U.S. growth this year.
Dick, we thank you so much for your time. Dick Berner there joining us there. He is the chief U.S. economist from Morgan Stanley.